Hi friends, in our series on demystifying Ind AS, today we are going to talk about the first time adoption of Ind AS. The relevant standard for the same is Ind AS 101, and this is the most important standard for preparing the opening balance sheet on the date of transition. As was discussed in the initial discussion on the roadmap to Ind AS, date of transition means the beginning of the earliest comparative period presented. If there is a company, say Y Limited, which has to adopt the Ind AS from 2017-18, its date of transition will be 1/4/16. Since the comparative financial statement will be presented for the period 2016-17, and hence the beginning of the earliest comparative period presented will be 1st April 2016. Now, this is a very important date and this is a very important task for the preparation of the first Ind AS based financial statement. And why it's important, why it is a complex task is you are required to convert your balance sheet of 31st March 16, which was prepared as per the Indian GAAP, into the opening balance sheet on 1/4/16 as per the Ind AS. So if this standard would not have been there, let me explain what you were required to do. Then you would have been required to assume that throughout the life of this entity, if the entity would have been following Ind AS, how the trial balance of this entity would have looked like on 1st April 16. Now that would have been a very tedious task, and hence this IFRS 1 and its equivalent standard in India, which is called as Ind AS 101, has been introduced to provide that relief. In this case, as many as 20 optional exemptions have been given to the company, and the beauty is that a company can pick and choose which option they want to apply prospectively and which are the items where they want to go retrospectively. So if an item falls into any of these 20 optional exemptions, then the company has a choice, otherwise it will not have a choice. Let me also give you some important tips on how to do this task. What you should do is, you should look at your Indian GAAP trial balance insofar as it talks about the balance sheet items on 31st March 16. Look at each item of the trial balance. See what item should be recognized in the Ind AS opening balance sheet, what item should be derecognized, which item requires a reclassification, and which item requires a remeasurement. When you have done the same for each and every item, you will be able to do this task easily, provided of course you understand the other fundamental principles. As I said, there are 20 optional exemptions and a company must evaluate which option suits them better, which option they would like to apply. Now these 20 options can be largely classified into 4 categories. One, which relates to the fixed assets or the property, plant and equipment and intangible asset. Second, relating to business combinations or the consolidation. Third, relating to financial instrument, and fourth is the residual category. Let me take you through all these 20 optional exemptions. The first one is relating to the fixed assets. So there is an option that you can fair value your property, plant and equipment on the date of transition, or you can retrospectively restate your items of property, plant and equipment. And there is also an option to combine this option of fair valuing or retrospectively restating. Consider an example. A company has 20 pieces of fixed assets divided into 4 classes of assets: land, then plant and machinery, furniture, fixture and vehicles. What a company can do is, it can decide to revalue 2 items of land, that is, find out the fair value on the date of transition, and the remaining 2 items it can restate using the principles of Ind AS 16. Similarly, for plant and machinery, it can do the same for furniture and fixture and for the vehicles as well. So it can make any combination as far as the fair value or the retrospective application of Ind AS 16 is concerned. And as we said, there is another option. There is a carve out which has been made to ease the process of transition, and that carve out is that if a company wants, it can use the carrying value of the property, plant and equipment. This carrying value has to be as per Indian GAAP, and that value can be used as the starting point for the opening balance sheet. But if this option is elected, then the option of fair valuation or the retrospective restatement of any of the item of the property, plant and equipment will not be available. The next option pertains to the decommissioning liabilities which are included in the property, plant and equipment. And then the third is regarding leases. So a company can apply the principles of Ind AS 17 in respect of a FRIC 4 or in respect of the some other items from the date of transition. Fourth relates to the service concession arrangement, and fifth is for the stripping cost in the production phase. Coming on to the business combination related exemptions, the exemption which is given is a very generous exemption. A company can choose to apply the business combination standard Ind AS 103 either retrospectively or prospectively or even retrospectively from a chosen date. Say for example, the date of transition for a company is 1/4/16 and it has done some business combination in 2007, 2009, 2015. Then the company can say that we will apply this standard on business combination retrospectively to all the business combinations. In that case, it will have to restate all the business combinations since its inception. Or it can also choose a date. Say for example, it chooses 1/4/2015 as a date, and then it can decide that from here on we will restate all the business combinations. And thirdly, as we said, it can also apply this from the date of transition, which is 1/4/16 in this case. Then there is also an option relating to investment in subsidiaries, associates and joint ventures. A company has an option to state its investment in subsidiaries, associates and joint ventures on cost or fair value, and this can be exercised item by item, that is investment by investment. Third relates to the assets and liabilities of joint ventures, subsidiaries, associates, and fourth is the cumulative translation differences. So just to illustrate, if a company has an accumulated amount in its foreign currency translation reserve, it can reset it to zero on the date of transition. But please remember, this is an optional exemption. A company may choose to do so or may choose to ignore this option. Fifth relates to the joint arrangements. On the financial instrument side, the options are on compound financial instrument. If the compound financial instrument is there, then a company is required to split the same into debt and equity. However, if that item has already been converted into equity on its date of transition, then a company has an optional exemption not to do so in respect of such instruments. Then there is also an option of fair value measurement of financial assets and financial liabilities, designation of previously recognized financial instruments, extinguishing financial liabilities with equities, designation of contracts to buy or sell some financial items. In the residual category, again there are 5 exemptions. These pertains to the severe hyperinflation, non-current assets held for sale and discontinuing operations, share-based payment transactions, insurance contracts, and transfer of assets from the customers. Friends, also remember that there are a number of areas where a company cannot apply the standard retrospectively. We call them mandatory exceptions, and these exceptions are as under: use of estimates, hedge accounting, derecognition of financial assets and financial liabilities, some aspects of accounting for non-controlling interest, classification and measurement of financial assets, impairment of financial assets, embedded derivatives, and government loans. Thank you.